Welcome to our Budget Countdown special. Today we discuss the macros. The earnings so far, corporate earnings so far, especially FMCG companies, is casting fresh doubts on whether the economy really bounced back in the third quarter from the second quarter lows of, 5.4%. So should we expect a budget that will recognize this slowdown and indulge in more subsidies or income transfers? Will the trend of rising Capex by the government plateau or even fall? What kind of nominal GDP growth and tax growth or tax buoyancy should we assume? And above all, will it continue to aggressively cut the fiscal deficit, the government that is? For all these questions, I'm joined by two top-of-the-rung economists, Santanu Sengupta of Goldman Sachs and Pranjul Bhandari of HSBC. Pranjul, of course, joins me in the studio. Thank you very much, Pranjul and Shantanu, for joining. Okay, Shantanu, Pranjul, let me first start by asking your growth assumptions. Shantanu, your real and your nominal GDP assumptions, and whether lately you have brought them up or down.
Hi, Latha. So we have been almost at the bottom of consensus for a while now on growth. We are at 6.1% GDP growth for the current fiscal year. We're looking at 6.3 for the next fiscal year. Nominal GDP growth in the handle of around 10%, maybe a shade higher going into FY26. It'll be slightly lower in FY25. That's sort of the broad assumptions. I think the bigger picture is that India is in the midst of a cyclical slowdown, mainly policy-driven in our view. And we can discuss if there is any policy room to stimulate the economy at all.
Okay, that precisely will be my question, but let me get Pranjul's view as well. I didn't know 6.1, Shantanu, by the way. Okay, very quickly, what's your third quarter assumption in that case?
We're at 5.9 for the third quarter. Tracking estimates are pointing slightly higher, but there's an amount of liquidity tightness that is going on in the system right now, and therefore we are not super hopeful about the recovery, at least in the first half. The second half is possible going into this year.
Okay, and I take your point. The Reserve Bank's nowcast in the bulletin was 6.2 for the third quarter. But of course, the nowcast is perhaps not a very sacred number. Your thoughts, Pranjul, what are you assuming for this year next, more important?
See, our sense is India's post-pandemic potential growth has been 6.5%. And eventually, if we get the right policy stimulus, we get there. But we may not get there in December, and we may not get there in March. Hopefully, by June, we get there. For FY26, we are assuming we get there, and we are assuming a 6.5% real GDP. But I think for the remaining two quarters of FY25, I think we'll probably stay in the 6.2% handle.
Okay, so for the full year, we are like 6.3 or something?
Somewhere there, yeah, 6.2, 6.3.
Okay, so between the two of you, not much, not very different as far as this year is concerned. Okay, Shantanu, because you're saying that next year, that is FY26, you're expecting only 6.3, not a big jump despite what should be a good base. You won't expect this budget to recognize that slowness and go in for more revenue expenditure rather than capital, more subsidies or transfers. Will that be a policy thrust at all?
I think there'll be recognition of the slowdown in certain pockets of the economy. We don't think this is the broad-based slowdown. Even if you look at consumption, there's an urban mass which is dragging the top end. What we are calling as affluent India is still driving growth. It's pretty good. We think that rural economy is recovering at the margin. In line with what you're saying, there are some fiscal transfers which are already happening at the subnational or the state government level. You're seeing that welfare payment, transfer payments, subsidies increase to the point of 0.5 to 0.6% of GDP over the last couple of years. Even if there's recognition, our bigger point is that you might want to shift around expenditure a little bit from Capex towards welfare or transfers, but the net fiscal impulse on the economy is still going to be negative, or there's going to be a fiscal drag if you're going to consolidate the deficit. And I don't think there's any question, at least in our mind, of whether the government will be consolidating or not. I mean, there's no question of expanding deficits at this stage of the cycle.
So 4.7 or 4.8 is not at all on the cards, according to you?
Even if it is 4.7, for instance, Latha, from 4.9% of GDP this year, you're still going to have a fiscal drag because you're consolidating the deficit. So unless you go towards like 5+ % of GDP, the net impulse on the economy is negative. Now, within that, we can think about the mix and whether you want to shave a little bit from Capex, you want to allocate more towards welfare or transfer payments or subsidies. But overall, we think that the room to maneuver is relatively less.
Okay. Pranjul, I think you're also going with a 4.5% fiscal deficit, like many of the economists. So will there be a juggling? Will there be, letting go of this Capex theme that has dominated the budget for the last 4 years? Just let go, let it fall to maybe 2.9% of the GDP or whatever, 3%, and, switch to stronger income transfers.
I hope not, actually, Latha. I do think that the government should and will stick to the fiscal consolidation path, bringing down the deficit from 4.8 to 4.4. And it's very important. Growth is slowing, but what India has right now is macro stability. Inflation is low, current account deficit is stable, and fiscal is on its way down. The deficit is on its way down. Let's not mess that up. The cost of that would be very, very high. But within the space that you have, which is limited space, how can you best, give money for growth? And my sense is what the government has done well in the last couple of years has been Capex, and I think they should not change that at this point of time. States are giving a lot of current expenditure, a lot of cash transfers. Let states run with that. I think the central government should stick to Capex. Couple of reasons. Central and state
But they're not able to spend, no.
That was this year. It was FY25. It was an election year. We had important national elections and a very important state election. I do think that public Capex comes in cycle, and we are at that point where a new cycle can start. Now, I don't think they can raise it in a very big way, but I would go with a budget estimate for Capex in FY26 of about 11 trillion. What they had hoped to do in FY25, I'm hoping they at least aim to do it in FY26. And one last word. Capex comes in, state and center move together. If center starts doing more Capex, states will start doing more Capex. Capex gets you the jobs, it gets you in construction industry to go up, it gets you a medium-term capacity to grow. Why leave all of that? It really served us well until we were doing it, which was FY24.
I could go on a tangent and make a debate out of some of these points. A lot of Capex now is prefabricated structures. Some decades ago, when Mumbai had a bridge, there would be slums that would grow. Now it is all prefab. So I don't know how capital intensive it is. And, I'm not qualified to talk about that. But, also Capex from the states, the manner in which it is getting distributed with so many conditions, the state governments pretty much often complain. But Shantanu, what's your sense? Will the Capex amount be lower than the 11 trillion or 11.111 trillion?
So we are baking in 3.2% of GDP on capital expenditure, which means that you sort of remain flat year over year in terms of percentage of GDP, which effectively means you're growing at nominal GDP growth rates, around 10%. But remember, the CAGR growth that you had in nominal expenditure on Capex post-pandemic was about 25%. That gave you a fiscal boost from the Capex side to the economy over the last 3 years. We've been flagging for the last year and a half that that pace of expenditure growth cannot continue. It's just a fiscal imperative or the fiscal reality that we are facing with 85% debt to GDP. And therefore, if the overall fiscal deficit consolidates and you're hitting sort of the lower bound in terms of your current expenditure, especially on subsidies, then Capex will have to take a hit in terms of percentage growth rate. We still think that around 11 trillion, if they deliver, is a solid number. For India, it has multipliers. I would agree with Pranjul that this has positive multipliers for the economy, and the supply side needs to be strengthened. That's what ultimately pushes up your potential growth. But our bigger point is that in a consolidating environment to the tune of around 30 to 50 basis points on the fiscal deficit, the room to maneuver from a government is relatively less to provide a boost to the economy in terms of fiscal impulse.
Yeah, I think we all have to learn to accept that it's a very small terrain that they can really play around. But Pranjul, overall, what is the big thrust that the budget is likely to have? Will it be a big employment thrust, which was there last year? Or will it be a big housing thrust because of the multiplier that it can give? Will it be a PLI, grab this, the supply chain thrust?
I think, three broad things come to mind. I think number one, macro stability. Stick to your fiscal consolidation path. and hand over the growth job to RBI. And I think RBI has the space given inflation is coming down a lot. Our January inflation forecast is 4.2%, quite low compared to 6.4 just in September. The second one, I think, is manufacturing jobs. Great opportunity. Again, supply chains could be getting rejigged this year. In Trump 1, you did not become a magnet for mid-tech FDI. Try and do that. But that will want you to be, you have to dare to be different. When the world is getting protectionist, don't increase import tariffs, actually reduce some of them. Go sign FTAs with the US and other advanced economies and let the currency be flexible. And the third one is revival of Capex, because over the long term, that's the only source you have of creating capacity and jobs. So I would say these three should be the main pillars of the fiscal on February 1.
Okay. Well, Shantanu, time permitting, I'll get to the big thrust from you also. But first of all, I wanted to ask you, you've assumed a fairly strong, tax growth. I think you're assuming that the income tax, for instance, from 3.9% of the GDP, which is the revised estimate for the current year, you're expecting it to rise to 4.1%, which means you're expecting income tax to continue to grow. But when you look at the urban consumption and the other signs of slowdown, are you still enthused to assume such a strong tax growth?
As I said, consumption is not a homogeneous slowdown. Consumption, in our view, has been very heterogeneous. You're having the urban mass, which is slowing down. Some of it is driven by the macroprudential tightening by the RBI on consumer loans. Their contribution, that section's contribution to income taxes, is relatively lower. I mean, we've shown this in our budget preview that the higher income earners are contributing more and more to income taxes, and that is the section of the population which is still delivering in terms of job growth as well as income growth. I mean, services exports is one number you should look at to understand, what the kind of growth is in that segment of the population, and therefore we are pretty hopeful that we can get to around 4% of GDP on income taxes, whereas our assumption on corporate taxes is lower given the cyclical slowdown in the economy and lower earnings growth possibly going into next year.
Okay, very quickly, 10 seconds, what will be the big thrust, Shantanu?
We think that rural housing program, some credit towards MSMEs for them to kickstart the cycle of investment. And we are hoping that financing of India's green energy and energy security versus transition needs get addressed in the budget, not just in terms of fiscal allocations, but in terms of setting up the framework or the structure to carry on that investment going forward.
Okay. I'm sorry, I've just whetted your appetite. Out of time, season of earnings, you see. Thank you very much, Shantanu and Pranjul, for giving us an idea of what we should expect in the budget in terms of macros. Wrap up on Bazaar on that note. Chartbusters coming.